Well, 40% is the number, the share of GDP. They're larger than that when it comes to GDP growth because these countries are, for the most part, growing faster. Yeah, I mean, China is central to the whole thing because the trade war, as you rightly suggest, is part of the story. There was a little jump in the dollar anyway last spring, but once the trade war story got hot, the dollar was up by 7 or 8% by the early autumn, and the Chinese yuan was down by 7 or 8%, both trade weighted and in real terms. So the result was that they sort of exported the problem to the rest of the world, including all the other emerging markets, many of whom are in deficit. But you see, they've also got, and you had a slowdown essentially that started mid-year. It's not 2019, it's the second half of 2018 is a slowdown. Japanese GDP fell 0.6%, and you've just published a number talking about Japanese exports being weak. Now, as it happens, October was a strong month, but October, November average not so good. Chances are that Japan is in recession. They're sitting there, they're suppliers to China, and that hurts them because China itself is slower for all the reasons you stated. And on top of that, they are competitive with China, and the cheaper yuan makes it very much harder for Japan, for Korea, for Taiwan to compete.
So in retrospect, and I remember when we were talking about tariffs in the first quarter, second quarter of the year, before they actually got imposed, many economists said it's difficult to put a number on what the actual impact will be. In retrospect now, we've had tariffs running for a couple of months, but talk of tariffs going for most of 2018. How much of an economic impact do you think it has had on global growth?
I think it's huge, exactly for the reason I just stated. First of all, you've got this 40%, which is in difficulties. 15% is China and 25% is all the other EMs, and they're both in trouble for different reasons. But this sort of double whammy of a rising dollar that increases import costs and a cheaper yuan that reduces export revenue, or at least makes it more competitive, all of that is bad news for practically everyone. So you had Germany down 0.2% in the third quarter. Italy down 0.1%. Well, Germany and Italy are the big manufacturing economies of Europe, of the big four, that is. Spain up 0.6%, France 0.4%, Britain 0.6%. You know, the service economy is doing quite well still, but there's this problem with manufacturing.
So you're thinking about the impact of a China slowdown on Europe. It seems to be exacerbating issues that are coming up on the domestic side of things in Europe as well. Now, you just flagged Germany and Italy in particular as being vulnerable to a slowdown in China. Just yesterday, we saw the IFO come in at its lowest in more than 2 years. So putting this all together, is all of the negativity really fully understood in Europe, or are we looking at more disappointment in 2019?
No, I think there's a serious problem, and oddly enough it becomes fairly difficult even if there is a settlement of the trade war issue. That obviously in itself will be helpful, but if there's a settlement of the trade war issue, then the euro is going north in style. And if the euro goes north in style, then the Italian competitiveness problem becomes acute. It's already pretty serious. Germany, in the third quarter, in spite of the fact that GDP was down 0.2%, had a positive contribution of 0.7% from inventories. That means there's a whole heap of stock sitting there waiting to supply anyone who actually wants to go and buy something in Germany. So, I mean, in principle, it doesn't demand, it may be not too bad, but you know, output is not going up much. May even go down. There may be a recession in Germany and there may be a recession in Japan already in the second half of 2018. And 2019 is going to have a knock-on straight on through.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.